You know, there's something about the market that never changes. It's the same old game played by different faces. Prices rise, prices fall, people hope, people fear. But only a few learn to read what the market is really saying. And today, I want to talk to you about one of its most deceptive tricks, the fake out. You remember, in the previous video on Track the Market's Hidden Language, we spoke about how the tape whispers its secrets to those who listen closely. Well, today's lesson is the next step in that same conversation, how to trade fake outs and win big by seeing through the market's lies. Now, let's get something straight before we go any further. A fake out isn't your enemy, it's your teacher. The market uses fake outs the same way a magician uses sleight of hand. It makes you look one way, while the real move is forming in the other direction. You think the breakout is real, you jump in. And the next moment, you're trapped, wondering how the same chart that looked like a golden ticket turned into a bear trap. Tell me, hasn't that ever happened to you? I learned early that the market loves to punish impatience. A trader sees a stock break above resistance, volume kicks up, and he buys, thinking he's ahead of the crowd. But he's not ahead. He is the crowd. The pros are already selling into that strength, feeding his enthusiasm. That's the fake out. It's not about the line on your chart. It's about who's doing what behind that line. The market shows strength, but the smart money is unloading. The crowd sees a breakout. The professional sees an exit. The fake out is one of the market's purest psychological tests. It asks you, do you believe what you see, or do you understand what you see? Most people believe. Very few understand. That's why trading isn't about predicting what the market will do. It's about interpreting what it's doing right now. You've got to think of yourself as a detective at the crime scene. The clues are there: volume, price action, momentum. The question is, are you looking at the evidence, or are you just following the story the crowd wants to believe? You see, every fake out begins with a truth. That's what makes it powerful. The move starts with real energy, real participation. But somewhere along the way, the smart money changes its position. The stock hesitates, wicks appear, volume dries up, or spikes too sharply. If you've trained your eyes to notice these small changes, you'll see the difference between a genuine move and a staged one. The market always leaves footprints. You just have to care enough to trace them. And when I say win big, I don't mean in dollars. Not yet. I mean in discipline. Every time you avoid a fake out, you're not just saving money. You're building judgment. Judgment is the trader's real capital. Without it, even a large account will eventually shrink. With it, even a small stake can grow. Now, let me ask you, how many times have you caught yourself saying, "It looked perfect," right after a trade went against you? That's the market teaching you that perfection on a chart doesn't equal profit. A setup can look flawless, but if it's attracting too much attention, it's already spoiled. The big money never chases perfection. They wait for emotion, for the crowd to get excited, for the weak hands to reveal themselves. Then they strike. A trader must learn to think like a hunter. The prey, the crowd, moves in herds. They react, they chase, they panic. You can't afford to do the same. When you see a sudden breakout, don't rush. Ask yourself who's buying here and why. What are they trying to make me believe? The tape will tell you. If you listen without emotion, this connects right back to that idea from the previous discussion, when we talked about the market's hidden language. The fake out is that language in disguise. It's the pause between words, the tone behind the sentence. It's not just what price does, but how it does it. You can't learn that from textbooks. You learn it from watching, losing, studying, and finally seeing. When I was young in the game, I used to take every breakout I saw. I thought the stronger the move, the faster the profit. But the stronger the move looked, the more likely it was that someone smarter than me was setting a trap. It took time, and losses, to understand that the best trades often don't look exciting. They look uncertain, even dull. That's when the real money is positioning quietly. The fake outs, on the other hand, are loud. They make headlines. And that's exactly why the public can't resist them. A good trader waits for the fake out to finish its act. Let it trap the others first. Let it spring, fail, and pull back. Then, when the weak hands are shaken out and the market reveals its real direction, that's when you act. You don't have to be the first in. You just have to be right. You ever notice how the market rewards patience the way it punishes ego? Every time you hold back when others rush in, you strengthen your edge. Because the crowd doesn't know how to wait. They crave action. But the professional knows the best trade is sometimes no trade at all. That restraint, that calm in the storm, is worth more than any single winning position. Trading fakeouts successfully isn't about prediction, it's about timing and confirmation. You wait for the trap to be set and sprung. Then you trade the reaction, not the rumor. The market always gives you a second chance. The question is, will you still have the clarity to see it when it comes? And that's where the mindset part enters. Wealth in trading doesn't come from being right often. It comes from being patiently right. From learning when not to act. The big money isn't made by trading every move. It's made by sitting tight on the right one. You can't do that if your capital is constantly being chipped away by fakeouts you could have avoided. So when you see the chart breaking out of its range, don't just think about what it means. Think about who it means something to. Are you part of the setup, or are you part of the trap? The answer to that question decides your future in this business. Most traders never make that shift. They think trading is about being smarter than the market. It isn't. It's about understanding yourself while the market tests you. Every fakeout is a mirror showing you your own weakness, greed, fear, impatience. Conquer that, and the fakeout becomes your signal, not your downfall. So next time you see that candle break through resistance, volume spiking, your heart racing, pause. Take a breath. Ask yourself, is this the market moving, or is it moving me? Every fakeout is a lesson in market language and self-control. That single line might sound simple, but it carries the weight of every trader's experience in the market. Because behind every trap, every sudden reversal, every perfect-looking breakout that collapses under its own excitement, there's a message. The market is talking to you, but it's speaking in a language that only patience and discipline can translate. You see, the market doesn't communicate through words, it speaks through movement, through hesitation, acceleration, and silence. Each fakeout is a sentence in that hidden language. It's not random, it's not noise, it's intention disguised as confusion. And the trader who learns to read those subtle signals becomes fluent in the only language that truly matters in this business: price action. Now, think about this. How many times have you been fooled by a move that looked too good to ignore? The candle breaks through resistance, momentum surges, and every fiber in your body screams, "Gettin'." But the moment you do, the market turns against you. It's as if it waited for your entry just to prove you wrong. You're left staring at the screen, wondering how something so obvious could go so wrong. That's not bad luck. That's a failure to understand the market's dialect of deception. Fakeouts happen because human behavior is predictable. The crowd reacts emotionally, not logically. They see a breakout and think opportunity. Professionals see the same breakout and think liquidity. The crowd buys into strength, and the pros sell into that strength. The fakeout is the intersection of hope and experience. It's where the uninformed meet the prepared. When you study fakeouts deeply, you begin to see they're not accidents. They're mechanisms. They serve a purpose, to shake out the impatient and reward the observant. Every false move clears the field of emotional traders, leaving the patient ones ready to catch the real move. So, if you can control yourself when the crowd cannot, you gain an edge that no indicator or algorithm can give you. That's why self-control is the key to reading the market's language. The chart may show the same bars to everyone, but the meaning changes depending on who's watching. The impulsive trader sees opportunity in every flicker of price. The disciplined trader sees a question: is this real, or is this bait? And that difference in mindset makes all the difference in the outcome. You might ask yourself, how do I develop that kind of control? It doesn't come from theory. It comes from exposure. from watching fakeouts form, fail, and repeat until your emotional reactions begin to quiet down. You start to notice that the market often behaves the same way before a trap. Maybe there's a strong push followed by hesitation, or a sudden surge in volume that looks too aggressive. The signals are there, but they only reveal themselves to a calm observer. In time, you stop seeing fakeouts as losses or frustrations. You start seeing them as messages. Each one tells you something about the crowd, how eager they are, how fearful they are, how easily they can be swayed. And when you understand the crowd, you understand the market, because the market is the crowd. The price only moves when people act. So, every fakeout is a snapshot of human nature on display. The greed to chase, the fear to miss out, the impatience to act. That's why studying fakeouts doesn't just make you a better trader, it shapes your mindset for wealth building. Trading is not only about money, it's about behavior. Wealth doesn't stay with those who react, it stays with those who observe. Fakeouts train you to wait, to confirm, to think beyond the first impression, and that same patience applies to how you grow and preserve your capital over time. You stop gambling and start managing. You stop chasing returns and start cultivating consistency. There's also a deeper truth in this idea. The market's lessons repeat until you learn them. If you keep falling for fakeouts, it's not the market that's tricking you. It's your own lack of control. The chart isn't out to get you. It's just a mirror reflecting your weaknesses. Every false breakout you buy into is an invitation to study yourself, not just your method. Were you greedy? Were you afraid of missing out? Or did you rush in because you couldn't wait for confirmation? When you start answering those questions honestly, your trading begins to evolve. You realize that self-control is more powerful than prediction. Anyone can spot a pattern, but only a few can wait for it to prove itself. That waiting, that calm in the middle of excitement, that's where professionalism begins. And ironically, it's that very patience that turns fakeouts from traps into opportunities. You see, once a fakeout plays out, it leaves behind valuable information. It tells you where the crowd got trapped. It marks the levels where weak hands entered and exited. Those levels become fuel for the next move, the real move. When price retests that area, and this time holds instead of failing, that's when you step in. You're no longer reacting to emotion, you're responding to structure. The fakeout becomes part of your plan, not your mistake. And that's the essence of learning the market's hidden language. You stop being surprised by its tricks. You start recognizing the rhythm. You see the build-up, the deception, the exhaustion, and finally the truth. Each fakeout refines your ear for that rhythm. You begin to anticipate not by guessing but by listening. The market speaks, but only those who have mastered themselves can hear it clearly. Because in the end, the difference between traders who survive and those who don't isn't just knowledge, it's composure. The market will always have fakeouts, traps, reversals, and chaos. But if you can remain steady in the face of that chaos, if you can interpret its language without letting your emotions translate it for you, you'll find clarity where others find confusion. Fakeouts reveal trader psychology, not market direction. That's a truth that most never fully grasp because they spend their time staring at charts, not studying behavior. The chart is only a mirror. It reflects what traders are thinking and feeling at a collective level. Every candle, every spike, every sudden reversal. It's a glimpse into the emotional state of the market. So when you see a fake out, don't ask what the market is going to do next. Ask what the people in the market are doing right now. Because that's where the real information lies. A fake out is never random. It's the direct result of how traders react to perceived opportunity. The market doesn't move on news alone or on fundamentals. It moves on belief. Traders believe a breakout is real. They buy in, and that belief, multiplied by thousands of participants, creates the very surge that triggers the trap. Then, when the market reverses, that same belief flips to panic. You can almost feel it on the tape, the sudden shift from excitement to disbelief, then to fear. That's not the market speaking, that's the traders revealing themselves. You ever notice how most fakeouts look convincing? They have all the right signs. A clean breakthrough resistance, a burst in volume, maybe even confirmation from some indicator. But it's exactly that clarity that makes it dangerous. When something looks too clean, too obvious, it usually means the crowd has already spotted it. And once the crowd agrees, the professionals start taking the other side. They need buyers to sell into, and fakeouts provide them the perfect stage for that transaction. The key to understanding fakeouts isn't in the candle pattern, it's in the context. What's happening behind the move? Who's participating? What's the motive? A sudden breakout after a long range can attract emotional traders, those waiting for confirmation. But the professionals, they see that surge as a chance to unload. So, the move looks like a breakout, but underneath, it's just distribution wearing a mask of strength. That's how the psychology plays out. Hope disguises itself as momentum. When you start to interpret fakeouts as expressions of trader emotion rather than failed technical patterns, your perspective shifts completely. You stop blaming the market for tricking you, and you start recognizing that it's your own assumptions being tested. The market didn't lie. Your expectations did. It's not about price betraying you. It's about your psychology reacting too quickly. The fakeout exposes the gap between what you think the market should do and what it's actually doing. Ask yourself this. Why do fakeouts work so often? It's because most traders trade what they want to see, not what's really there. They get attached to a story. They see a resistance line as a gateway to profits instead of a battlefield between buyers and sellers. So when price crosses it, they celebrate, not realizing that the war isn't over, it's just begun. A fakeout is that final ambush, the moment when emotion overrides logic. The professionals, on the other hand, are psychologists as much as they are traders. They understand crowd behavior. They know where the stops are, where fear hides, and where greed takes over. They anticipate not just the chart, but the reaction. When they create or recognize a fakeout, they're not betting against price. They're betting against emotion. That's why studying fakeouts is one of the fastest ways to understand how markets truly operate. Fakeouts are windows into collective psychology. They show you how easily people can be persuaded by movement, by color, by momentum. A red candle makes people nervous, a green one makes them confident. The irony is that both colors mean nothing without context, yet traders treat them like signals of destiny. The fakeout exploits that simplicity. It says, "Here's what you want to see," and then it flips the script. That's not manipulation. That's human nature being reflected back through price. You learn more about yourself in one fakeout than in 10 winning trades, because fakeouts force you to confront your impulses. They expose whether you're patient, disciplined, or simply reactive. Did you chase that breakout because your analysis confirmed it, or because you didn't want to miss out? That difference defines your future performance. Every time you fall for a fakeout, the market is telling you, you're still trading your emotions. Every time you avoid one, it's telling you, you're beginning to trade your understanding. That's what makes fakeouts such valuable teachers. They're not failures, they're mirrors. They reveal how the majority thinks and behaves under pressure. The crowd always reacts the same way, too fast, too emotional, too certain. And if you can learn to observe that behavior without joining it, you start to trade from a position of strength. You begin to see that fakeouts are not traps laid against you. They're signals showing where emotion is at its peak. Think about how this connects to your daily trading habits. When you analyze a chart, are you looking for a setup, or are you looking for emotion? Because the best traders don't just see patterns. They see psychology embedded within those patterns. They know that each wick, each reversal, each volume spike is a fingerprint of human behavior. The fakeout, in that sense, is the most honest pattern of all, because it shows both sides of the game, the greed that drives the entry and the fear that drives the exit. Understanding that truth transforms how you trade. Instead of reacting to breakouts, you begin to study them. You wait for the crowd to show its hand. You let the trap spring, and then you analyze who got caught. Did volume rise sharply and then vanish? Did momentum die the moment price broke out? Did the candle close weak after looking strong? Those are not coincidences. They're behavioral footprints. They tell you the story of how the crowd was drawn in and where the smart money likely stepped aside. Over time, this awareness changes your entire relationship with the market. You stop feeling deceived and start feeling informed. You no longer view fakeouts as failures to predict, but as opportunities to understand. Each one deepens your grasp of how traders think, fear, and act. The more you watch, the more fluent you become in that unspoken dialogue between price and psychology. The strongest looking moves often hide professional exits. That's one of those truths the market teaches you only after you've paid tuition in losses. The cleaner the breakout, the sharper the rally, the more confident the crowd becomes. And that confidence is exactly what the professionals use as a signal to start unloading their positions. The market has a way of dressing up its traps in brilliance. When everything looks perfect, that's usually when danger is closest. Because perfection in trading rarely belongs to the public, it belongs to the professionals who designed it that way. A professional exit doesn't announce itself. It doesn't happen in a rush or in chaos. It happens quietly, elegantly while the crowd is cheering for higher prices. You'll see volume expanding, price breaking past resistance, and traders flooding in with excitement. But underneath that enthusiasm, something different is happening. The large players, the ones who moved early, who accumulated before the public noticed, are distributing. They're selling into that strength, handing their shares to latecomers who believe the move has just begun. That's the irony of the market. What looks like the beginning to one trader is often the ending for another. You ever wonder why a stock can rise on heavy volume and then suddenly collapse without warning? It's because those who knew what they were doing were using that surge to exit. They needed buyers to take the other side, and when the crowd arrived, the liquidity they required appeared. To the untrained eye, it looks like momentum. To the trained eye, it looks like opportunity, not to buy but to sell. The psychology behind this is simple but powerful. The crowd loves confirmation. Traders crave validation that their view is right. When price breaks out of a range or pushes into new highs, it gives them that emotional comfort. See, I knew it. But by the time they feel that comfort, the professionals have already acted. They don't need confirmation. They move when the risk is low, not when the crowd agrees. And so when the move looks strongest, that's when the balance shifts. The informed quietly exit, the uninformed eagerly enter. This pattern repeats across every market and every time frame. Whether it's a daily chart, a 5-minute chart, or a yearly cycle, the principle doesn't change. The most convincing breakouts, the ones that look like they can't fail, are often the points of exhaustion. Think of it like the final burst of a runner who's already spent his energy. The move looks powerful, but it's running on fumes. You can see it in the behavior of volume. Heavy at the top, fading as soon as the push ends. That's the professional signature. They don't run after the move. They let the crowd finish it for them. And here's the hard truth: the market rewards patience and punishes excitement. The crowd can't resist a strong-looking move because it satisfies something deep inside, the desire for certainty. They want to believe they've caught the start of something big, but the professionals think differently. They look for signs of emotional extremes, and when they see enthusiasm turning into frenzy, they know it's time to lighten the load. That's not manipulation, it's just understanding psychology better than the rest. If you pay attention, you can spot these exits. The clues are subtle but consistent. Price begins to make new highs, but each new high has less conviction. The candles get smaller, wicks grow longer, and volume stops supporting the move. You'll also notice hesitation. That brief pause before the reversal. It's not weakness in price, it's strength in selling. The market is absorbing the crowd's buying power until there's nothing left to sustain the move. Then comes the drop, sharp and fast, because once the professionals are done selling, there's no one left to hold the line. Ask yourself, how many times have you entered a trade on that strong breakout, only to see it reverse almost instantly? That's not coincidence. That's the professionals cashing out while you're stepping in. They don't fight the crowd, they feed it. Every buyer who believes he's early is actually late to them. That's the cruel elegance of the market's design. When you start thinking like a professional, your whole approach shifts. You stop chasing strength and start questioning it. You ask, who's on the other side of this trade, instead of, how far can this go? You understand that markets move in cycles of accumulation and distribution. The professionals accumulate when the crowd is bored or fearful. They distribute when the crowd is excited and confident. So when everything on your screen looks bullish, that's the moment you should become suspicious. This ties directly to the concept of tape reading, the old art of watching how price behaves under pressure. During genuine strength, the market breathes naturally. It builds, pauses, builds again. But during professional exits, the moves become erratic. You'll notice sudden bursts followed by hesitation, wide candles without true follow-through. It's like a conversation where the tone doesn't match the words. The price is saying up, but the behavior underneath whispers done. Inexperienced traders often think manipulation is about hidden forces pushing price around unfairly. But most of what they call manipulation is just distribution. It's the professionals exiting efficiently, using the crowd's enthusiasm to do it. And if you study their behavior long enough, you realize it's not them deceiving the market. It's the market revealing who understands emotion and who doesn't. Over time, as you internalize this lesson, you stop feeling the urge to chase every breakout. You learn that the best opportunities aren't the loudest. The quiet, uncertain phases, the times when the crowd is unsure and the chart looks indecisive. That's when accumulation often happens. The strong-looking moves, the ones that make headlines and fill social feeds, those are usually exits in disguise. The professionals are patient enough to sell into confidence. The crowd is emotional enough to buy it. So the next time you see a breakout that looks flawless, ask yourself, who benefits from my buying here? If the answer isn't you, step back. Watch what happens after the excitement fades. If the move is real, it will hold. If it's professional distribution, you'll see weakness appear where strength used to be. The tape never lies, it only reveals the truth slowly, one tick at a time. The fake-out tests understanding, not prediction. That's the part most traders never grasp, and it's why they keep getting caught in the same traps again and again. They come to the market thinking their job is to predict what will happen next, as if the market is a puzzle that rewards guesses. But the market doesn't pay you for being a prophet, it pays you for reading what's happening now and responding with discipline. Every fake-out is a test, not of your strategy, but of your ability to understand what's really taking place behind the price. The average trader wants certainty. They want to know, before entering, that the move will continue in their favor. That desire alone is what makes them vulnerable. The fake-out feeds on that desire. It offers just enough confirmation to make you believe your prediction was right. A breakout past resistance, a surge in volume, a candle that looks like momentum is about to explode. Everything seems to align perfectly with your expectations. But the moment you enter, the market reverses, as if mocking your conviction. That reversal isn't random. It's deliberate behavior caused by emotion dominating reason. And if you look closely, you'll see that the market wasn't testing your prediction. It was testing your understanding of its behavior. You can't predict fake-outs because they're born from psychology, not logic. They emerge when too many traders see the same thing and act in the same way. The chart reflects that collective behavior. When everyone believes a breakout is real, the imbalance creates the conditions for it to fail. Professionals see that imbalance as opportunity. They know where the stop losses are sitting, where the crowd is eager to enter, and they use that information to move in the opposite direction. So while the majority is focused on prediction, the professionals are focused on understanding. They don't ask, what's going to happen? They ask, what is happening to the traders right now? This distinction between prediction and understanding is the true dividing line between amateurs and professionals. The amateur trades forecasts, the professional trades conditions. The amateur says, "I think this will go up." The professional says, "I see buyers trapped here," and that changes the structure. That difference in thinking is what keeps one constantly reacting and the other patiently observing. The fakeout exposes that difference. It punishes those who trade expectations and rewards those who trade comprehension. You ever notice how, during a fake breakout, your confidence is highest just before the reversal? That's not coincidence. It's human nature. When you predict something and it begins to unfold in your favor, your brain craves validation. You feel smart, capable, right? That emotional surge clouds your ability to read the signs that things are shifting. You're so attached to your prediction that you stop interpreting what's actually happening. The fakeout feeds on that attachment. It waits for conviction to turn into blindness, and then it strikes. To truly pass the test of a fakeout, you must shift your focus from being right to being aware. The trader who understands what's unfolding doesn't get attached to outcomes. They see the market as a conversation, not a scoreboard.